SoundCartel.
From SoundCartel, I'm Nicole Goodman, and this is Business Essentials Daily. Global economic uncertainty is having ripple effects throughout Australia's business community, putting many small and medium companies at risk. In the latest of our special series of pre-election interviews, we take a more global look to see where a post-election government might find itself. Robert Brooks, Professor of Economics and Business Statistics at Monash University, highlights the risk of inflation, exchange rate pressures, and why smart, steady policy responses may help shield local businesses from the worst impacts. Professor Brooks starts by describing the current situation to Jeff Waters.
It is certainly true that the global macroeconomic settings have been considerably challenging as a result of trade policy and tariff policy in the US and around the changing nature of that policy and around the uncertainty about where that all ends up. So what do we know? We do know that the indicators of volatility and turbulence in markets have remained elevated. If you look at the volatility index, the VIX, which is used as one of the major measures of the fear index in financial markets, that is still sitting at elevated levels to where it's been historically. It has moderated a bit from the heights it got to when we thought we were going to have a very broad set of tariffs. So the pause has helped on that, but it does remain at elevated levels. The other piece of global uncertainty that certainly sat there has been this issue that, traditionally when financial markets have turbulence, you see people invest in safe haven assets. And so gold, has always been this traditional safe haven asset that people go to in times of risk. One of the other big safe haven assets traditionally has been US Treasuries. People are investing in US Treasuries, so the price of those bonds is going up, so the yields on them is coming down. What we saw in the recent period is in fact not that flight to safety going into US Treasuries. So I think elements of the policy settings have been a recognition that having the volatility index at elevated levels is not desirable, and having US Treasuries not being seen as a safe haven asset is not a desirable state of affairs as well. Now, the uncertainty piece around that, of course, is if we've now got lots of countries needing to do individual deals with tariffs that were calculated in a way that, really just looked at trade deficits and import volumes as distinct from, looking at specific non-tariff barriers, that deal piece and that reciprocity piece around how that's going to work remains a challenge. But if you take at face value elements of the comments on this from the US, that part of this has been about having some sort of deals to remove trade barriers, then what we do need to see over the next period of time is some deals getting done. And that remains a source of uncertainty in the short term. Clearly, the China setting on that one has been, extremely different, where it clearly has escalated into this tit-for-tat style retaliation. That's clearly undesirable from a global economy setting because it makes growth in the US lower and it makes growth in China lower, and you don't know how long those retaliation cycles go for. It seems to have settled a bit. There still seems to be some tweaking of the settings going on a little bit, but those US and China tariffs remain at, very high levels relative to one another. That's a risk to growth. Now, the risks to growth, I think, are perhaps different dimensions in the two settings. So if you're sitting in China, we know that the sources of economic growth in China have looked different to the rest of the world in the sense that domestic consumption expenditure has traditionally played a much lower role in Chinese economic growth than it has in other economies. And China has had a much bigger export-led growth strategy. So the policy question that sits on the China growth piece is, do you try and rebalance that and get some more domestic consumption happening, although that's proven challenging to move in the past. The US side of it, I think, is this sort of different dilemma as to, do you now have a risk of higher inflation in the US? What does that higher inflation mean for what has to happen with monetary policy in the US? And if you take at face value the view that part of the US tariff policy is about some reshoring of manufacturing and bringing some manufacturing back, it's this complexity of how you do that in really complex global supply chains. And so, for decades now, the US, with some of its manufacturing, has become part of these really complex and really well integrated global supply chains. And the capacity of that to adjust quickly remains a considerable challenge. So the risks to growth in the US are of a different nature. I think it's more of an inflation risk, and it's more of a how much reshoring of your manufacturing base can you realistically do in reasonable time horizons. The China one is this mix of consumption and export-led growth. China does have the possibility, if it can get consumption playing a bigger role in its economic growth, to not be as reliant on export-led growth. But that hasn't been its traditional model to the same extent.
As you said, we're looking at possibly inflationary effects in the United States. Will that flow on to Australia, and if so, how?
The Australian dimension on this is actually a really interesting question. So the first bit of policy that's been very desirable here has been to not get into any retaliation cycles around tariffs and trade policy, because retaliation cycles just raise prices for Australian consumers and they feed into inflationary pressure. So that's been actually a really desirable feature of the political situation that we found ourselves in at the minute, that both of the major parties have been really clear that getting into trade-based retaliation is not a desirable thing to do. So that's good. The Reserve Bank, I think, from the comments they've made, have stayed cautious around the inflation bit. There's been some speculation of, would we see large cuts in interest rates because of concerns about global growth? I think the bank's tried to articulate its thinking that it sees too much of an inflation risk in making large-scale interest rate adjustments. So I think that measured approach will stay part of it, and I think that helps moderate the inflation risk in the US. That risk that's there in the US is certainly not there for Australia to the same extent. One, because we haven't done the retaliation, and the second is because we have a central bank that's still got a really clear and well-articulated view of what it's going to do. Now, where we do get a sort of more interesting macroeconomic risk setting is around exchange rate factors. So exchange rate factors do remain a big issue in the Australian setting, and the exchange rate factors are really speaking to this question of what's actually happening with the US dollar. So the US dollar's been depreciating recently as well. Australia's been depreciating relative to the US dollar, which has been a depreciating currency. So that's an interesting risk. And it's also then trying to work out, what does the Federal Reserve in the US need to do with its monetary policy and interest rate settings, and how does that feed through into exchange rates? Now, the exchange rate depreciation, to the extent that people are relying on, integrated supply chains, then potentially does. Australia's main sort of inflation risk, I think, comes through potentially exchange rate factors. That said, we seem to now have got to, after a bit of volatility in the Trump immediate period after the Trump tariffs, we seem to have now got to a more settled exchange rate situation. But that exchange rate factor is a risk. But there is a version of the world where, Australia is well placed to avoid some of the inflationary risk pressures that are sitting in the US. Our risk is actually more a global growth risk, and in particular, a growth in Asia risk situation, which is about China, but it's also about the other, really important economies across North Asia, Southeast Asia, and into South Asia more generally. That global growth risk is a real challenge for us at the minute.
That was Robert Brooks, Professor of Economics and Business Statistics at Monash University. This episode of Business Essentials Daily is produced by the team at SoundCartel. Thanks for listening. I'm Nicole Goodman. We'll bring you more Be Daily tomorrow. Follow at BE Daily Podcast across social media and head to bedaily.com.au for more from the Business Essentials Daily podcast. SoundCartel.